You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, interest rates going up. We now see the 2-year is well over 5%. And our erstwhile Fed chair, Jerome Powell, is promising another 50 basis point hike. Where will it all end? What is it doing to real estate? Is real estate still the place to be? Because certainly up until the rate hikes, it definitely was. I mean, the returns were phenomenal, and we just saw more and more and more going up there. But, hey, we got James Dainard on with us. James, you flip houses in the Pacific Northwest, and we're talking pre-call. What is the impact that the Fed rate hikes are having on you?
Well, it's having numerous different effects as an investor in the Pacific Northwest, especially when we're buying a lot of single family properties. The first thing it's really doing is it's slowed down the disposition. So when we're reselling these things, it's taking about 2 to 3 times longer than it was to get a move. So it's adding more debt cost and expense cost. And then what we've seen since the Fed, we've seen it the market kind of level out since the Fed started doing more half point hikes and taking it back a little bit. But that first initial 4 months of rapid rate hikes really affected the values of flips. And if you were buying flip properties at the beginning of the year, chances are your property was going to be worth about 10% less on a compression basis on what the pro forma was. And so we've seen most of the drop off a peak, not off median. And, that peak values for a lot of markets were up, 10% in the first quarter. And so we've seen it kind of come back down to the median home price of 2021. So
you've seen a decline, and how much higher the rates go, and what does that do to the future of your business?
So I am anticipating the rate. I think there's a lot of rate hike already priced in to today's mortgage rates as inflation's kind of starting to battle back. We could see the rates up another point by the end, I would say by quarter 3. From what I'm hearing, that the rates should start falling by quarter 4. But, they keep coming up with these predictions and then they're wrong most of the time. And so right now what we're doing is we're building in a point extra when we're looking at selling off properties. And then what we do on an eval process is we just reduce our exit values or our target dispo value based on the rates. If we think the rates are going to be higher, then we adjust down based on percentage and what the cost of money is.
Okay. So prices go down, but you try to keep your returns at the same level or higher.
Yeah. And right now with the riskier market, the last, like you just said, the last 2 years, everyone wanted to be in real estate. You can make returns that weren't real, in my opinion. They're not realistic return expectations. We've been flipping homes for a very long time in the Pacific Northwest. Typically, your margin on a flip property is going to be 30 to 35% in a 6 to 7 month period, and that's using leverage in there on a cash on cash return basis. We were seeing 100 to 150% returns, if not even 200% for 2 years, and that's not normal. And so for us, during those 2 years, people will be more aggressive on buying because of the appreciation factor. Now we've just taken a step back and we're underwriting deals like we were doing in 2017, 18, where, we have higher expectations on flipping and returns. In addition to, we're just packing our performance because in a riskier market, you can do any kind of business in any type of market. You just have to mitigate the risk. And by mitigating the risk, we expect bigger returns, which does mean that we're doing a little bit less deals, but they're safer deals.
Okay. So are you attracting cash buyers? Or are these people actually taking out mortgages at 7-8%?
A lot of them are taking out mortgages at 7-8%. Some, I would say probably 10% of our flips or 20%, we still have cash. There's still a lot of foreign money presence in the Pacific Northwest, but most of them are just traditional buyers because what's happened is there was still this pent up demand and there's still not enough inventory. And when the Fed was going into these 3/4 point hikes, it kind of went into a mini free fall for a second or compressed back. And then everybody, the consumer naturally gets spooked the easiest and they want to sit out on the sidelines. And so we had this 5 months of very, very low transactions where there wasn't a lot of bodies. We've seen almost a 500% increase since Jan 1 on showings than we did for that last winter quarter. And so I think what happened is it got slow because a seasonal slowdown came back. COVID and the amount of money in the market kind of took away that seasonal slowdown. The fourth quarter's always been slow in real estate, usually for transactions. Mm-hmm. So that kind of came back. Then you had the mental, what's coming out in the press. People are anticipating this crash of real estate because it spiked so hard. And so everybody kind of sat off. And now what we're seeing is as the market kind of leveled out, people are getting FOMO again. If they say good house, they're buying it. And so they're still using that 7-8% money. It's just, they're just buying it for about 5% less than they were during peak.
Really? All right. So price appreciation is definitely down, correct?
Right. Yeah. We're not seeing growth in our performance at all. It's appreciation has slowed dramatically. We did just sell 2 properties last weekend for about 2% above our pro forma, which was a good thing to see because we did buy these deals at the beginning of the year too. So I think it comes down to also where is your exit price point for where your median target buyer is. We're seeing like in the Pacific Northwest, the sweet spot forever was if you were selling something that was 800 to 850, that was going to sell really well because that was like your tech single buyer. 125 to 135 was like your tech buyer that was married with another tech buyer, dual income. And so those were our sweet spots. Now what we're seeing because of the cost of money is the sweet spots kind of came down to 600,000 to 700,000 in that range. And those are actually still moving and getting a little uptick in value. So it's about looking at the market, identifying where the sweet spots are and where the most buyer demand is. And if you're in that range, we're actually still seeing a slight tick up in that. Majority of the stuff has compressed back and now has started to level out.
All right. So how much further do you think interest rates are going up?
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has an excellent shareholder base with Ross Beatty owning 20%, insiders 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Right now, I'm anticipating, because I'm trying to plan for the worst a little bit, I think the cost of money is going to be about a point higher than it is right now.
Yeah, you think so, huh? What if you're wrong? What are you going to do then?
Well, then I'm going to make more money because we're running our performance like that. So it's just building in the, if the rates come down, we're still buying. So we buy in every market. We were buying in 2008 when it was in a massive free fall, 2009, 10, flat. And so we're always buying. And so for us, it's just about mitigating the risk. If the rates go down, that means that our value on our performance is probably going to go up because we did see when rates fell for a 4-week period, we saw a huge surge in the market, at least in the Pacific Northwest. And so that just means we're performing our deals correctly and mitigating the risk. If the rates go down, we should sell it for more. And so that's upside in the deal, but that, we don't really factor the upside in the deals. That's just, it's all market timing at that point.
All right. So I want to run something by you because this is a trend that I don't think has been recognized in the industry, but the concept of that people default on their mortgage and then the home gets foreclosed. I think we're coming to an end of that. I think there's no appetite. If we have another real estate crash, we're not going to see 10 million foreclosures because they're just not going to put up with it. So what we're going to see are workouts and voluntary vacates. We're going to see deals getting made. We're not going to see the judicial system used as a giant clearinghouse for defaulted home loans, because I think the socialist trends in the country are just going against that remedy for mortgage holders to get their property back.
Yeah, I don't see, I mean, the affordability and payment, that's going to really come down to, I hear that a lot, though. I do think foreclosures are going to increase because rates have gone up. And I think they have something to do with it, but it has to do more with what's going to happen with the economy in general and whether people's income is going to, right now we have a massive labor issue too, where the cost of labor has gone up substantially. And the Fed is making an effort to try to battle back those labor costs by raising rates. If they put our economy into a spin, that's going to really dramatically change the foreclosure projections.
Right.
But right now, what we're seeing is people have bought property, they locked in low money, and they can afford that payment. And they put down substantial down payments. A lot of these people sold their homes, had a big equity gain, sold it, and put that as a down. So it kind of mitigated the risk of being underwater at that point and the affordability factor. We're not anticipating a wave of foreclosures like we saw in 2008, because in 2008, the faucet turned on and it was like inventory was everywhere. And it was kind of hard to identify what good opportunities were.
Well,
I think we're going to see
two reasons. And I mean to interrupt. Two reasons why I don't think that's going to happen. Number one is they're not making those garbage mortgages, liar's loans, not to the extent they were, and the collateral is going to cover it. The Fed has successfully re-inflated the market. But the other reason is, even if there is a mass default, they're just not going to use the legal system to remedy the situation this time. It was vastly politically unpopular, a lot of bad press for the banks and for the government and for the regulators. They're just going to let the lenders take their lumps, and they'll have to do workouts and such. But hey, we won't know that's going to happen until it happens again. So your forecast for the coming year, you're projecting a 1% increase in rates from where we are today, and you think that the vast majority of the damage to the market has already been done. Do I have that right?
That is correct.
All right. Well, hey, spoken like a true real estate entrepreneur. I wouldn't want to hear anything but that from you. What's it going to take to scare you out of the market?
You know what? We didn't get scared in 2008, and that was really scary. It's just we're always buying. As long as you underwrite your deals and you can execute on those plans, there's always ways to make a return in real estate. Like, it's just a matter of what you're buying. We're big fix and flip guys, but also, most recently we've done more deals in the last 9 months than we did in the last 2 years combined on volume. And the reason being is there's more opportunities in different spaces. We're able to lock up a lot of big apartment buildings now and close on those at very high cap rates, which we could not see. So when the market shifts, there's always an opportunity. You just got to find the one you're good at and then get after it at that point. And so I think there's a lot of opportunity coming our way.
All right. Well, I guess we'll leave it at that. Hey, if you've got a question for James or myself, shoot us an email, kl@kerrylutz.com. And go to the site, financialsurvivalnetwork.com. Get your free newsletter. James, just tell us again what your website is.
It's jamesdainard.com, or you can find us on social media at jdainflips.
All right. And you will find a link to James's site in the show notes on financialsurvivalnetwork.com. Again, emails are welcome, kl@kerrylutz.com. Leave your comments on the YouTube channel below if that's how you're watching us. James, really appreciate you coming on, and thank you again. We'll talk to you again soon.
Cool. Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.